With the price of oil recovering from the last drop, oil makes the world go around, and there's no sign of that changing anytime soon. Petroleum remains in high demand, and it's an efficient way to generate energy. Petroleum also has a multiple of uses in the industry, and it can be used as a lubricant and is key component in its creation of plastic. Natural gas, for its part, is a popular source of heating and cooking energy. It can also be converted into diesel fuel and electricity. Now, you might be wondering if now is the right time to invest in oil stocks? Hi there, welcome to Investors Game. Today, we're gonna talk about how to invest in oil stocks. And don't forget to share this video with family and friends and hit the like button if you haven't done it yet. Now, let's get started. While oil and gasoline prices are relatively low compared to historic norms, this makes a big opportunity to buy if demand for natural gas increases, resulting in a price increase. Also, we use daily products derived from petroleum. Petroleum products are used in more ways than you think. Many people associate oil drilling with gasoline only, but that's simply not the case. Some products derived from petroleum are umbrellas, mops, curtains, golf bags, paint, etc. There's currently no substitute available for petroleum, which gives us a high dependence of the product. Since there is no substitute, the world relies heavily on the supply of oil to create all the products. But how can we start investing in oil sector? You can approach oil and gas investing in a number of different ways. For example, you can consider the industry a collection of companies providing products or services to customers, as well as to other players in the oil and gas industry itself. You can also approach the industry as a commodity and seek to profit from changes in the price of crude oil, gasoline, diesel, and other products. Here are some ways to start investing in oil. Number 1. Invest in a mutual fund or ETF. Alternatively, you can buy shares of oil and gas focused mutual funds or ETFs through a brokerage like Investing by JP Morgan. These help you gain substantial exposure to the commodity without taking direct risk in a commodity spot prices and without trying too much of the fortune to the perspective of any one company. Number 2. Invest in the stock related to the sector. These are two methods to gain exposure to the oil and gas markets, both via publicly traded companies. The most obvious being ExxonMobil, one of the largest companies in the world, as measured by market capitalization. You can also buy in other companies such as British Petroleum, PetroChina, Chevron, Conocophillips, Shell, and many other companies. Each of these companies engage in oil exploration, and you can buy direct exposure to them simply by buying shares or ADRs through your broker. Number 3. Invest in futures contracts. You can purchase derivatives such as oil and gasoline future contracts. This, however, can be risky since futures contracts can frequently expire without any worth. If the price of oil looks like it's continuing to increase, you can also hold the future while it appreciates in value and sell it at a later date to an investor who does intend to exercise it. Number 4. Small or micro-cap stock and limited partnerships. If you want to take a more direct equity position in a smaller company or project, you may consider making a play further down the oil and gas industry food chain into a small or micro-cap stock, or even a limited partnership that focuses on oil and gas. This is a more specialized field of investing, and if the business is not publicly traded, you will typically need to engage the services of a broker who specializes in the industry for access to these kind of businesses. Or if you have a significant amount you can invest it, you can deal with the company's management directly for a private placement opportunity. Alright, now that you know how to invest in oil sector, you have to decide what kind of oil investment you want to make. Broadly speaking, there are 4 kinds of oil and gas investments. Number 1. Exploration and production. These companies or projects buy or lease land and invest in money in drilling. If they extract oil, the investment can pay off 10 times over. Sometimes much more if the company uses borrowed money, leverage, to finance operations. If not, they might lose nearly everything they invested in their particular project. Pure exploration companies are the best situated for those with very high tolerance for investment risk. These plays are highly speculative. Companies in these sectors are Aramco in Saudi Arabia produces 5 million of barrels every day, while ExxonMobil in US produces 2.6 million of barrels every day. Next, developing. These projects drill near proven reserves, hoping to unlock further value. These are somewhat less speculative, but there are never any guarantees that their efforts or any one plot of land will be fruit. Next, income. These projects involve the acquisition of plots of land, either through lease or purchase, over proven oil and gas reserves and seek to create a steady stream of income over and above expenses. This is generally the safest way to involve, especially in the drill and extraction operations, and is more of income play than a speculative play. The risk is that the oil or natural gas will run out faster than expected. This investment is for those seeking a passive income stream, but who can take on more risk than those investing in other traditional income sources, like investing grade bonds and annuities. Next, service and support. These companies provide a nearly unlimited menu of supporting services to the oil and gas industry. Examples include transportation, shipping and logistic companies, pipeline companies, construction and rigging companies, drilling and refining hardware and equipment manufacturers, refiners, and many other companies. Investing in these companies is similarly to investing in any other companies involved in B2B services, logistics, and technology. Some of these investments don't rely on increasing fuel prices to be profitable. For example, pipelines make money by charging a fee per barrel transported. They'll make roughly the same amount regardless of whether fuel prices rise or fall, as long as demand remains consistent. Now you might be wondering, but what advantage do I have investing in oil sector? Here are some advantages that you can take investing in oil sector. Number 1, diversification. Oil and gas investment have historically provided a useful diverse against the overall economy. When gas prices rise, economies tend to slow. An exposure to oil and gas stock can help you insulate your portfolio against economy slowdowns caused by oil shocks. Next, profit potential. Investing in smaller companies and limited partnership can occasionally pay off big. A simple well can generate many times its cost if drillers strike oil, and the well can pay dividend for many years. Next, tax advantages. There are some tax advantages to oil and gas investing. For instance, the IRS allows companies to deduct for depletion, an allowance similar to that for depreciation in rental real estate, which is a way of accounting for the gradual exhaustion of mineral supplies in a given plot of land. If you buy shares in a publicly traded stock, this benefit will be largely invisible to you. Since publicly traded stocks are C corporations and don't pass their gains and losses to shareholders' tax returns. However, if you buy a membership in a limited partnership, this could be a very important consideration. Depletion could be the difference between a property that's cash flow positive and one that loses money. Also, investing in any type of asset comes with some degree of risk. However, investing in oil stock has a specific risk you should understand. Here are some cons in this sector. Number 1, volatility. Oil and gas investment can be subject to wild pricing swings, especially when investing in a smaller company. If you involve in exploration, drilling projects, you can easily lose a great amount of money. Diversification is the key to oil and gas investing. Losses of 50% or more are not unusual, and you can lose anything on any project. Next, liquidity. While you can usually quickly sell shares in a larger company, you may have a hard time finding a buyer for shares of a smaller company. In some cases, you may have to redeem your interest with the company or limited partner directly. This is frequently the case with closely held, not publicly traded companies and limited partnerships. Don't become involved in this unless you're willing to tie up your money for a while. Next, commissions. When you buy into a limited partnership or closely held corporation, you will typically pay a commission to a broker or intermediary. These commissions tend to be much larger than the standard stockbroker commissions, and can exceed 20% for very liquid companies. Any money that goes to a broker is money that doesn't get put to work for you. Next, complexity. Interest in closely held companies, oil wells, and other ultra-micro-cap oil and gas projects aren't for everyone. There are special tax rules that govern oil, gas, and mineral investments, and there are rules specific to limited partnerships that may affect you. Especially as you file taxes or account for shares when you sell them, I don't recommend limited partnership or MLPS, master limited partnership, which are limited partnerships that are publicly traded, except to very experienced investors who are in a position to take risks and have money committed for a long period of time. However, you may have better luck selling shares in a MLP than in a not publicly traded limited partnership. Aside from supply and demand factors, another force driving oil prices has been investors and speculators bidding on oil future contracts. Many major institutional investors now involved in the oil market, such as pension and endowment funds, hold commodity-linked investment as a part of a long-term asset allocation strategy. Others, including Wall Street speculators, trade oil futures for very short periods of time to reap quick profits. Some observers attribute wide short-term swings in oil prices to these speculators, while others believe the influence is minimal. Investing in oil markets means investors have a diverse array of options, from indirect exposure via energy-related stock to more direct investment in a commodity-linked ETF. The energy sector has something for almost everyone. As with all investments, investors should do their own research or consult an investment professional before investing real money into the market. If you like this video, don't forget to hit the like button. Let me know in the comment box, would you invest in oil sector? Subscribe to my channel because every week I'm in YouTube with new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.